In just a few days' time, we watched the stock market wipe away $9.6 trillion in market cap. And so a lot of investors are wondering, what should I be doing right now with my portfolio? So let's go through exactly what you should be thinking about as you assess your 401k in the midst of these volatile times. Now, if you're new here, I'm Jonathan Rankin. I'm the founder and CEO of Theorem Wealth Management. We're a retirement-focused firm that helps people just like you plan and achieve their long-term retirement goals. Now, if you're new here, make sure that you hit that subscribe button. And if you've been joining us for a while, thank you for being here. And so let's go ahead and dive in. People are probably wondering, why are tariffs causing me to lose money? And there's a lot of reasons why, but the main reasons are the fact that it's unknown as to how these are going to impact the global economy. And so is this going to cause us to have more inflation? Is this going to cause our US economy to go into a recession? We really don't have that answer, and it's going to take some time for us to see what this is going to do to the overall economy, especially here in the US. And so because of that, the market really doesn't like uncertainty, and that's the reason why we're seeing the volatility that we're seeing. So what can you actually do with your portfolio? Well, the first thing that you should be doing is really you should be assessing, why are you losing money? So it's one thing to look at the screen and see that there's red on the screen and the fact that your portfolio value has gone down, but why is it going down? So you want to review your current asset allocation. This is the mix that you have of stocks, bonds, cash, and other investments. If you've got some alternative strategies, but this is the mix that you have within those buckets. And you want to see, how much stocks do I own? How much bonds do I own? How much cash? And just have an understanding of, what is my current asset allocation? And then from there, look to why are you actually underperforming? What's underperforming? If you are overweight in stocks, well, then there's your answer. But within those stocks, you want to also assess, do I have any sort of overlap here? This is where, when people set up their 401k allocation, they typically just select a couple funds that are in the menu. And then from there, they don't really assess, what is the overlap of these funds? How much do these funds have in common? So if I have, let's say, an extended market fund and a large cap growth fund, my guess is that some of those stocks within those funds are going to be very similar. So what is that, and how exposed am I to certain sectors and certain parts of the overall economy? From there, you have to evaluate how diversified you are actually, because a lot of people might think, I've got 5 funds in my portfolio, I'm extremely diversified. But those 5 funds might be the large cap growth fund, the large cap value fund, mid cap, small cap, and international. And you go, well, wait a minute. I've got 100% of my portfolio in stocks. No wonder why I'm down so much, because when I thought I was diversified because I had a number of different funds, in reality, I wasn't diversified as much as I thought, or even at all, because everything I had was in some sort of stock. So the first thing you have to do when you're starting to lose money in your portfolio is you have to assess what's losing money and why. It is very important to start with diagnosing the issue first before you go in to start trying to fix it. Now from there, the next thing you do is you have to reevaluate what your risk tolerance is. This is extremely important, especially in times like this, because what we found is that market downturns and volatility, this is where people really find out what their true risk tolerance is. And they find out what they're actually comfortable with, because in an up market, everybody wants to grow. Everybody wants their portfolio to go up. And so the ability to just extend and take on risk is extremely prevalent in bear market or in bull markets. And so because of that, during a bear market like we're seeing right now, most people don't realize how exposed they were to risk. And they never really went through that volatility check until now. And so this gives you that opportunity to understand, what is your real comfort level, and are you comfortable with what you're seeing? Because that's going to help you as you build out your portfolio for the next couple of years and the next bear market that we see. Use tools like online quizzes, or you can work with an advisor. We'd be happy to help guide you and help you determine what your risk tolerance is, and help you understand, are you taking on too much risk, and what risk should you be taking on? This is very important. And so if you have questions, our team would be happy to help you out with that. We actually have a free quiz that you can take. It's in the description below, where we can help you come up with a personalized assessment of whether or not you're on track to your retirement. So go ahead and click that link, take the quiz, and we'd be happy to help walk you through all of that. From there, you have to look at, has your time horizon changed? For most people who are focused on retirement and saving in a 401k, they usually set up their allocation when they first started the 401k. And most people, that's where their contributions are going, and they haven't adjusted what that allocation is, even though over the years they might have gotten closer to retirement. So that's going to help determine, if your time horizon is only the next 2 to 3 years, well, then maybe we need to really reassess how much risk you're actually taking. And then from there, you really have to look at, does your risk in your portfolio align with what your goals are? Now, a lot of people don't invest based on their actual goals. They invest based on their age or some sort of target date fund. But it's important to understand, what are your long-term goals? How do you achieve them? And what type of risk and return is needed to actually achieve those goals? Because for a lot of the people that we've worked with over the years, we've always asked them the question, what's more important to you? Beating or exceeding or matching whatever the S&P 500 is doing, or achieving your long-term goals and not having to worry about money? Out of those two, most people pick the second one. That most people are a lot happier if they could just live the rest of their life in retirement without worrying about money. Well, that might be contradictory to trying to match whatever the S&P 500 is doing. And everybody wants the S&P 500 rate of return in the up years, but nobody wants it in the down years. And so you have to assess, are you taking on more risk than you need to in your portfolio? Or if you've been extremely defensive, are you not taking as much risk as you should be to capture long-term growth? So really aligning your portfolio with your long-term goals is really important, especially as you get close to retirement. Now, the next thing that you can do if you're looking at your portfolio and you're seeing that it's down is you can use this time to actually rebalance your portfolio. So what do we mean by rebalancing? Well, rebalancing allows you to shift the allocation back to its original target. So let's just say when you establish your portfolio, it was meant to be 70% stocks and 30% bonds. Well, over the past couple of years, we've had a few years where the market was up pretty strong. And so your stock portfolio, instead of being 70%, might have grown to 75 or even 80%. And your fixed income by default has become 25 or 20%. And so by rebalancing, what you're doing is you're using the stock growth and you're buying some of the fixed income growth. And by default, you're buying high and you're selling low. So it helps you buy underperforming assets. And if you have a globally balanced portfolio and you're investing in things like, that's not just large cap growth, so you're also investing in small cap and mid cap, you're picking up some of those assets as they've been in a bear market as well. It's important to do this on a routine basis. So a lot of 401ks, they have the technology where you can actually utilize their in-plan rebalancing tool, where it will automatically rebalance for you. So this way you can set up to do this either quarterly or semi-annually or at least annually. But if you haven't done this in a while and your portfolio's kind of gotten out of position because it's just you've let it run, that's okay. It's just now is a great time for you to be able to bring it back to whatever your core allocation should be. Now from there, you can use this time to increase your contributions. So increasing your savings and your contributions is a great strategy as the market's down, because this allows you to dollar cost average more when the markets are volatile. And by doing that, you're buying more shares at lower prices. And so by increasing your contribution rate, so maybe if you weren't maxing out your 401k before, and now's the time where it'd be a great time for you to start increasing that contribution rate. What you don't want to do is you don't want to go the opposite way. I've seen so many times where we go through periods of volatility and people decide, well, because every time I put money from my paycheck into my 401k, it just loses money, I'm going to reduce how much I'm contributing. You have to start using this as that opposite opportunity. Instead, just realize you're buying more shares at cheaper prices. So, do not, for whatever you can, just do not reduce the contribution rate you've got. In fact, do whatever you can to increase that. And that also means that if you haven't been capturing the employer match, if your employer does match you, use this as an opportunity to make sure you're getting 100% of what they match you. Because this is free money that's just been sitting there that you haven't been getting yet. But now, not only are you getting it, you're using their dollars to buy more shares at cheaper prices. So it's a win across the board. So whatever you can do, if you're not getting your full employer match, now is the best time to do so. And then use this time to assess whether or not you have the proper emergency fund set up, and do you have any taxable savings so you can stay flexible and possibly do any sort of after-tax investing as well, so that way you can actually take advantage of prices while they're lower. There was this great quote by Warren Buffett who said, the stock market's the only place where when things go on sale, people leave the store. And so, or it's something along those lines. I may have gotten a few words mixed up, but you get the gist. But that's a great way to think about it. Right now, stocks are on sale. And if you've got decades until you retire, this is the opportunity that you've been waiting for to be able to capture some of these markets as they're bottoming out. So use this as a time to build your wealth, and not as a time to just stop saving or shift your investments into any sort of just cash only positions. I've seen so many times where during different markets, people will take their money and they will move it out and they'll just sit on the sidelines, and they'll always miss the run back up. And so you don't want to put yourself in that position. I know times like this are scary. I know that it's concerning when you look at your portfolio and it's down 5, 10, 15, maybe 20%. And it could get a lot worse. We don't know. But at a certain point, we know that if we look at the long-term history of the stock market, it usually goes from the bottom left corner of the chart to the top right, and we just don't know the time frame. So if you're planning for retirement, the goal is you're planning for a 20, 30, or 40-year retirement. And if that's you, then you've got that time horizon. You just want to make sure that you've got that discipline. Now, the last thing you could do is you can look at in-plan Roth conversions. So an in-plan Roth conversion is where you take money within your 401k that's pre-tax and you convert it to Roth dollars. Now, this is extremely beneficial because of the fact that those Roth dollars are going to grow tax-free, and when you go to withdraw them in retirement, you don't pay taxes on those dollars as well. And so it's a very good strategy to do during a down market, because the market's already down. You can move shares, and you're essentially waiting for those to go back up to where they were, and you're able to do this at lower account values, which means it's going to be a lower tax hit when you do it. Because you got to remember, doing a Roth conversion is a taxable event. So keep in mind that you will have to make sure that you have money that's set aside for those taxes. But having that benefit of tax-free income in retirement because you have that Roth built up is going to be crucial when planning for your tax strategy in retirement. Now, you have to be mindful of your tax bracket. What is your tax bracket today? Because any conversion that you do is going to add income to that income tax bracket. So if you're already at the highest, tax bracket, then it might not make sense, because the whole thing about whether or not you are in a Roth or a traditional account, it all comes down to, is your tax rate today higher or lower than where it's going to be in the future? If your tax rate is going to be lower in the future, then consider continuing with the pre-tax. If you feel like it's going to be higher in the future, that's where the Roth might come into play. So just be mindful of exactly what your tax brackets are. And then the last thing is that you have to also make sure you have money set aside for taxes, because some 401ks will withhold for you on the conversion, but a lot of them won't. A lot of them will convert the dollars, and then at the end of the year, you get to reconcile with Uncle Sam, and the last thing you want is this, $20,000, $30,000, $40,000 conversion that you did, adding to your income that you didn't have taxes withheld on, and now you've got this massive tax bill come April of the following year. So just some things to consider. It's very important to make sure that anytime you're doing any sort of Roth conversions, whether they're in a plan or just standalone with an IRA and a Roth IRA that you've got, it's important to make sure you're doing all the planning beforehand, because once you do it, you can't undo it. So it's a good strategy to utilize, but just make sure that you're focused on all the nuances within that. So those are 5 different things that you can do as you're looking at your portfolio and you're wondering, what can I do now that things are down? I will leave you with this. The last thing that you want to do is use this as an opportunity to just bail on your investment strategy. Whatever your investment strategy is, you probably set it up in the very beginning because you wanted some sort of long-term growth, or you had some sort of strategy that you chose those funds for a reason. Don't just completely abandon that because we've had a few rough weeks in the market, because over time, we've had a lot more good times than we've had bad times. And at some point, we're going to see that things turn around. We never know when the bottom's going to be. And the bottom is only evident and extremely obvious when we look back at it. The bottom of 2009 was obvious when you look back. The bottom of 2020 was pretty obvious when you look back at it. But most of the time, when you're in it, everybody thinks it's going to go lower. All the pundits on TV are talking about how much lower the market can go, and it can be extremely scary during those times. So don't get caught up in the noise. Go back to your financial plan. Make sure you have a solid financial plan that's built. Make sure that your financial plan includes your long-term retirement strategy, distribution schedule, and cash flow analysis to make sure that you've got everything planned out so that this market doesn't affect your long-term plan. If you need help with that, our firm would be happy to help you. You can use that link in the description below to take that quiz. That'll help give you an idea of exactly where you stand for your retirement. And then from there, you'll get a personalized video from one of our team members that will actually walk you through what that plan looks like. And then hopefully we can set up some time where we can work with you personally to make sure if there's any changes that need to be made during this market, that you're doing them under the right pretenses. So if you have questions, we're here for you. I appreciate you watching. Best of luck out there in these markets, and I'll see you soon.